Assalamualaikum, madam. So my name is Ahmad Jamal Kauthar. I will be presenting the question 1, which is what is pre-acquisition reserve and why do we need to determine the amount first before you can calculate goodwill. So what is pre-acquisition reserve? It is the amount of retained profit or other reserve in the subsidiary that was there at the time before the parent's company purchased it. In simpler terms, pre-acquisition reserve are the profits or reserve earned before the acquisition. So next question is why do we need to determine the amount first before you can calculate the goodwill? So by finding the pre-acquisition reserve is necessary as they help in figuring out the net assets at the acquisition date. Goodwill is calculated as goodwill equals purchase consideration plus NCI minus net asset at the purchase date. So this matter because the fair value of net asset at acquisition date includes share of capital subsidiary, retained earning up to acquisition date, in other words, only pre-reserve acquisition reserve, for example, and other reserve up to the acquisition date. So if we wrongly include the profit made after purchase, the goodwill will be incorrect. So the goodwill estimate will be overstated or understated. If post-acquisition gains are accidentally included, resulting in the financial statement that are wrong. This is why it is important to correctly determine the fair value of net asset at acquisition. Hence, it will ensure the goodwill calculation reflects only what was paid at the time of acquisition, not the future profits.
Hi, madam. My name is SITHA. So today I'm going to present for our assignment 2. For the theory part, I was choosing for question 2, which is the question what fair value adjustment need to be determined by parent in consideration. In consideration statement of financial position, subsidy did not pick up any the fair value by the parent. Need to have consult the consideration process by recognize the fair value because to ensure the consideration financial statement accurately represent the true financial position. Where like accounting standards like IFRS 3 requires a subsidy asset at the fair value on accumulation date. For example, as I attach in slide, for the accumulation date on 1st January 2020, for the financial position date is 31st December 2020, and the land value is 4,500,000. As a situation 1, the fair value on land acquisition date is 5,500,000, and subsidy did not recognize asset fair value amount. For the calculation, we're going to carrying value, which is on 1st January 2020, and which is 4,500,000, and fair value on acquisition date 1st January 2020 is 5,500,000, and then we minus the how to get adjustment fair value minus carrying value, which is we're getting fair value adjustment on first 1 million. Then we're going to do the journal entry. This is the debit is land, credit is revaluation risk. We're getting a 1 million each. That's all for the theory part.
So good evening, madam. My name is TAASHINI Raman. For the theory part, I took question 3. So basically my question is what is fair value post-revaluation reserve adjustment? So before I jump into the question, I just want to explain about the concept. So basically the concept is the fair value of post-revaluation reserve adjustment usually relate to the revaluation model under MFRS 116, which is property plant equipment, and also MFRS 140, which is investment property. Basically it's refer to the updated carrying amount on the asset after it has been adjusted on the fair value, or the difference between the old carrying amount and also the new fair value. Either we have to add on the revaluation reserve when it has any gain, or have to deduct it from the revaluation reserve or charge on the profit or loss when we get any loss. So basically, example, I just want to give an example, madam. For the cost of building is like 800,000. For the revaluation value will be like 1 million. So basically the difference will be like 200,000, which is gain. So basically for the example journal entries will be like debit building, credit revaluation reserve for 200,000. So that's it from me, madam. Thank you.
And a very good morning to Madam Honey. So hereby I'll be presenting the theory section of why that we should determine the adjustment for depreciation as well. Okay, so the first reason is to reflect the true value of assets. So in this case, assets lose value over time. So depreciation adjusts their values so the balance sheet shows a more realistic amount. And the second the second point is to accurately calculate the net profit. So why we should calculate the net profit is because the depreciation is a cost of using assets. Recording it helps shows the real profit of after all the expenses. And the third reason is to comply with accounting standards. So accounting rules require businesses to record depreciation. So financial statements are fair and correct. So this is the three reasons for the determine the adjustments for the depreciation.
So we will move on to the next calculation part, which is on situation 2, which the question have given us the acquisition date of at 1 January 2019, and the price is 6.2 million, and then the useful life of the building is 60 years, and also the SOFP date at 31st December 2024 is 5.1 million. So on the 31st December 2022, the fair value has gone up to 7.5 million, and on the next year, 31st December 2023, have gone up also to 8.7 million, and the last one, it has gone up to 9.990 million on the 31st December 2024. So first, we need to find the pre-revaluation reserve. So as the question have given us the fair value amount of 6.2 million at the acquisition date, we need to find the carrying value for the same date, which is 1 January 2019. So the formula is 60 carrying value minus 6 carrying value divided by 60 years equals 5.1 million. And when you do the calculation, you will get the carrying value of 5,666 and 666.67. So after that, you need to compare the carrying value and fair value until you get 5,333 and 33 cents. So the general entry of the building is 5,333 cents, and the revaluation reserve is 533 and 33. So the next, after we get the pre-revaluation reserve, we will find the post-revaluation reserve and the first fair value. So the fair value on the date of 31st December 2022 is 7.5 million. So we need to find the depreciation for that year. So the calculation for the depreciation is 6.2 million, which is the figure from the first 6.2 million, divided by 60 years and times 4 years, and you will get the depreciation of 513,333.33. And then the carrying value, we need to minus the first fair value on the acquisition date and minus the depreciation. So 6.2 million minus 413,333.33, and you will get the carrying value of 5,786,666.67 cents. So the general entry of the building will be, we made the comparison of carrying value and the fair value, which is the building with the debit on the building 1.713333 and 33 cents, and also credit revaluation reserve 1.713333 and 53 cents. So moving on the post revaluation reserve fair value number 2. So we have been given the fair value for that year of 2023 is 8.7 million. So we need to take the fair value of 7.5 million as our main principal, divide by 60 minus 4 years, which is the year that we already depreciate, and one more year to add on, which we will get that 1.33928.57. That is for the depreciation. So for the carrying value, we need to use the past 7.5 million, the latest carrying fair value, which is 7.5 million, minus the depreciation we calculated just now, 1.33928.57, and we will get the carrying value of 7366071.43. So the journal entry, we need to make the comparison of carrying value and fair value. So the debit building 1.33928.57 and revaluation reserve 133,928.57, the same amount. So the next part is post revaluation reserve fair value number 3. So the fair value in the question given 2024 December is 9,990,000. So we need to use the fair value of past, which is 8.7 million, divided by 60 minus 5 years we already used in the timeline as given, and also the 1 times the 1 year. So we will get the depreciation of 158,181.82. So right now we will find the carrying value, and we will still use the 8.7 million as our principal, and minus the depreciation we get for the year, which is 158,181.82, and we will get the amount of 8,541,818 and 18 cents. So the general entry will be the comparison of fair value and carrying value. So the debit building 1448, 181.82, and revaluation reserve on the credit side 1448, 181.82. So now we will go on to the depreciation adjustment. So on the subsidiary depreciation, we just take the first amount of carrying value and divide it by 60 years to make the depreciation. As in, there's no fair value revaluation, and so we just need to divide the 60 years. So and then we will get the answer of 566.67. So on the parent depreciation part, it is a little different, since we need to put all the depreciation we calculated before on the depreciation fair value 1, which is 413,333.33, and depreciation 2, 133,928.57, and the last on the depreciation 3, 158,181.82, and then we need to combine all the depreciation to get the total depreciation for the parent depreciation, which is 705,443 and 72. After that, we need to compare the parents and the subsidiary depreciation, and when we compare, we just need to take the total parents depreciation and minus by the subsidiary depreciation account. So when you compare, and you will get 138,777.05. So on the journal entry part, there will be debit depreciation 138,777.05, and the credit side accumulated depreciation, the same amount, which is 138,777.05. So thank you, madam. That is all.
Good evening, madam. So the calculation part was took for situation 3, which is the financial position date on 31st December 2024, and the building amount was 2.1 million. And accumulation date is on 1st January 2021. As a given, the fair value on accumulation date is 3.2 million, and first fair value on 31st December 2021, which is 4.5 million, and the second fair value was given on 31st December 2024, which is 6.7 million. And first of all, we need to calculate the gap year, which is on 1st January 2021 until 31st December 2024, which is the gap year is for year. And the second part, we have to calculate the pre-bidding, is the fair value minus fair value minus carrying value. The fair value on 1st January 2021, which is 3.2 million, divided by carrying value on 1st January 2021. The carrying value we have to calculate based on useful life minus with the gap year, which is 4 years, and divide by useful life 60 years. Okay, for the 30 as a given with the building amount, which is the 2.1 million, times with 60 and divide by 60 years, divide by 56 years, which is we have the amount is 2. And the amount is 2.25 million, and then we have to find the fair value adjustment, which is 3.2 million, minus with 2.25 million, and then we get the amount, the fair value adjustment amount, which is 9,500. For the first journal, we're going to create debit was building and credit was revaluation reserve free, which is the amount 950,000. For the second part, we have to create for the post building, which is the fair value on 31st December 2021, and the carrying value, which is carrying value on 31st December 2021. For the fair value as a given 4.5 million, and then we have to calculate the carrying value, which is the carrying value on 31st December 2021. The 3.2 million have to divide by the useful life, which is 60, and times by 1 year. And the equation we get is 53,333.33. And then although we have to minus the amount, which is the building amount, which is 3.2 million, divide by 53,333.33. And then we get amount for, which is the amount we get is 3,146,666.67 cents. Means the amount we have to find we find the adjustment, which we get 1,353,000, is the amount 1,333,333.33 cents. For the journal, first journal, we're giving a debit building, credit is revaluation reserve post, which is the one for 1,350,333.33 cents. For the second journal, we're going to calculate as a given second fair value on 31st December 2024, which is a 6.7 million, and we're going to create, we have to calculate the carrying value, which is on 31st December 2024. From that, we can calculate the 45,000 divided by carrying useful life, which is 60, minus with 3 years. Because of 3 years, it's like from the 2021 until 2023, we have to minus. So 60 years minus with 3 years. So we get 57 years, and then times with 3 years, and then we get 23, which is we get 23,684.11. So for the 4.5 million and minus with the amount, we're getting a 4,263,157.90, which is the amount of 6.7 million minus with the carrying value, which is 4,263,157.90, and we get the amount 2,436,842.9. So the second journal, which is David was building 2,436,842.7, and for the debit side, revaluation reserve post was the same. For the third part, we have to calculate the depreciation adjustment, with the subsidy depreciation is 2.25 million. We need to divide for 60 years and times with the gap year 4 years, and which is the amount 1,500. And the parent depreciation is on 31st December 2021 until the 31st December 2023, which is the 4.5 million divided by 60 and times with 3 years, which is the amount. And the amount is 2.2 thousand. 2.25 million, and the last 31st December 2024, which is 6.7 million divided by 57 years and times with 1 year, and the amount is 117543.82, and we sum up this we total up the amount, which is we get 342543 and 886. For the journal depreciation, debit depreciation, credit accumulated depreciation, which the amount is 192,543 and 86. The amount is get from 1.5 million minus with 342,543.86. And the last part is consult SOFP as a non-current asset. Under the non-current assets, building 2.1 million plus with 6.7 million, and we get 8.8 million. Thank you.
Good morning to Madam Honey, and hereby I'm about to present the calculation part of SOFP here. So which means the first step is pre-revaluation reserve, and the second step is post-revaluation reserve, and the third step is adjustment of depreciation, and the fourth step is consolidated of statement of financial position. And hereby, I'm going to explain the first step of situation 4, which is pre-revaluation reserve. So it's a given year, which is 3 years, for the gap year, which is 3 years. The cost value for 1/1/2022, which is 1,157,894 and 74 cents. And for the fair value for 1/1/2022, which is 2,500,000. So once we minus off that both cost value and fair value, we'll be getting a 1,342,105.26 cents. And at the below there, we have to take the 60 CV, which is 60 cost value minus with 3 cost value, dividable by the 60, which is the useful life. We will be getting a 1,100,000. And the CV, we have to just maintain with the 1,157,894.74 cents. At last, we can conclude that the journal entries, which is debit building, credit is revaluation reserve, pre-revaluation reserve, which is about 134,2105.26. Okay, so we're going to explain the second step here, which is post-revaluation reserve. So there's a given time frame here, which is about 1/1/2022, 31st/12/2022, 31st/12/2023, and also 31st/12/2024. So the given fair value for 1/1/2022, which is the beginning year, which is 2,500,000, and for 31st/12/2023, which is the fair value was 3,500,000. So at the below that, so FV 31st/12/2023, which is 3,500,000, and CV for 31st/12/2023 was mentioned that 241,6666.67, and once we minus off the FV minus CV, we'll be getting there 1,083,333.33, and below that below that we have to find that 2,500,000 minus weight, which is the 2,500,000 we got from the fair value of the beginning year, which is 1/1/2022. We have to minus them with 83,333.33. So from where we got 83,333, we have to take the beginning year, which is 2,500,000, divided by the 60, which is the useful life, and we have to times by 2. So we'll be getting there 83,333.33. So once we minus them, we'll be getting the answer, which is 241,666.67. Okay, and hereby at last we can conclude that the debit is building, and the credit is revaluation reserve, post revaluation reserve. So which is about the value is 1,083,333.33 for the journal entries as well. Thank you. And here the third step, which is depreciation adjustment. So we have to take the parent depreciation subsist building. So for the 31st/12/2022, which is we got 2,500,000 divided by 60, you will be getting that 41,666.67. And for 31st/12/2023, there's no any depreciation there. So we have to maintain the 41,666.67. At the below last one, which is 31st/12/2024, we have to take a 3,500,000 divided by 58. So which means the 60 useful life have to minus by 2, and then we'll be getting that 58. So once we have divided with the 3,500,000, we'll be getting the 60,344.83. So once we total up all the numbers, we'll be getting a 143,678.17 cents as well. So that's the parent's depreciation subsist building. For the subsist depreciation, which is we go down here 115,78994.74 divided by 60 times with 3. So we'll be getting the answer, which is 57894.74. Okay, and the depreciation we have to do 143,678.17. We have to minus with the 57894.74. So once we minus them, we'll be getting the 85,783.43. So that's the answers for step 3. And the final step is consolidated statement of financial position as at 31st/12/2024. So, and hereby at the part of non-current asset, there will be a building. So how we got the amount, buildings amount, which is the parent's amount, have to minus with the subsidies amount. So the 3,500,000 minus with 6,034,483. We'll be getting here 3,439,633.17. So that's just the answers for the building amount. So here, this is how we